Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today we are going to be analyzing General Mills stock. This one came in by request down in the comment section of one of my other videos, and if you have a request just put it down in the comment section and I'll get it on my list on the whiteboard behind me, and eventually I will make a YouTube analysis video of it. If it's in the S&P 500, if it's not in the S&P 500, I post those in the full Cyclical Investors Club service, and then over on Patreon, which is $5 a month over on Patreon, and you get a big discount to the full Cyclical Investors Club service if you ever decide to sign up there as well. Those links will be down in the description. As always, this isn't individual investing advice. This is just how I analyze stocks, and I do track General Mills, so I already had run the numbers on it. I haven't, however, ever made a video or posted an article on General Mills, which is kind of surprising. In some ways, and other ways it's not, because it's not a very fast-growing business, and so it doesn't attract a lot of attention, for one, but two, it's kind of right on the borderline of where I would consider buying a stock, which we'll get into in just a minute. But first thing I always check is the long-term earnings history of a stock to see how cyclical the earnings are. That's the dark green shaded area here, and as you can see, their earnings are very consistent. I don't even know if they've had, I think they have had like a small down year along here somewhere maybe. But for the most part, no, I don't see any negative years, just close a couple times. So very consistent. A lot of people are looking for consistent earners, especially if they pay a dividend. These guys do. 3.6% yield. So usually a consistent earner that has a steady dividend, that has a decent yield, will attract kind of people to it, investors to it nowadays, because there's a lot of retirees looking for dividend paying stocks. However, I am not one of those dividend investors. But I can also see why someone would ask about it, because if you look at what the price has done since is that just this year? Holy smokes. Down 30% almost this year. So let's shorten this and make sure I have my time frame right. Yeah, from just less than a year, actually. So the stock's down a lot. I can definitely see why someone might be interested in it. So let's take a look at the valuation. So I'm going to base my valuation based on the historical earnings trend along with the current price, and see if it would make a good business to buy from the perspective like the owner of a business, and how much money you could theoretically collect in earnings from the business over the next 10 years. Let's see here. Yeah, I think that's it. Let's get into the analysis. I already showed that it wasn't cyclical, so we can just use earnings. There's no problem with that. I need basically two assumptions here, or estimates. One is the earnings growth rate, which I have at 4.21% since 2015. And the other is the current PE ratio, which I have as about 14 or 15. So if we look at the fast graph, they calculate their own earnings growth rate for this period. I shorten this up to, usually I pull this year's earnings forward, so shorten it up to there. And Fastgraphs has about a 5.13% earnings growth rate. They have bought back some shares, and that will inflate the earnings per share, which is what's here. And so I make some small adjustments for that, and assume that those earnings would be kept by the owner of the business and not be able to be spent on share repurchases. So I want to know what those kind of owner's earnings are and what that growth rate would be. And when I do that, it's a little bit lower. It's not that much lower, but I get 4.21% over this time period. So now that earnings growth rate is probably my biggest initial problem with the stock, and that's my note here. Earnings growth is a little bit too slow. This is actually right on the borderline of like what might be okay. But if you go back and just look at the performance of the stock just over this time period, will include dividends. You're getting a 5% total return, annual return over this time period. And what was the total? 50%. And inflation is probably 25%, I would say. So you're getting just a little bit more. That was buying at this valuation, obviously. You're getting just a little bit more than inflation. So they are able to pass inflation on, or they've shown that they can over time, but just barely, like just enough. There's really not any much growth after that. So, and if we look at the 3-year revenue growth rate, which this is cumulative, this is not annual, so this is going to be more like that 3% revenue growth rate. This might be short, maybe 1 quarter, but you're looking, that basically is matching the earnings growth. So it's telling you, these things are probably about accurate, and this is probably what you can expect if the trend continues into the future. Now, for me, that earnings growth rate's too slow, so I wouldn't consider buying it, but I can look at it from the perspective of somebody who thought, it's close, but it's okay, And if that's the case, what we want to do is get a valuation for this. So what I do is I take the earnings growth rate, I take the current earnings yield, which is, I adjust the stock price for any debt, which they do have some. It's not like a lot. I basically just look at the market cap. I look at the total enterprise value. I look at what sort of percentage higher the total enterprise value is from the market cap. And then I raise the stock price theoretically by that much when I'm creating the earnings yield and the PE. So it's the price that I use to calculate that is 23% higher. There's the real stock price. But if we take the debt into account, then this is what the stock price would be. So that's what I do in order to get this. So it's going to be more conservative than if you didn't take that into consideration. So 5.54% earnings yield, which means if you bought this company for $100, the company would earn $5.54 a year on that $100 for every $100. And then it's growing a little bit. So I pull that forward for the first year. So I assume you'll get $5.78 on $100 the first year, and then that continues to grow and accumulate over 10 years. The $5 grows, and the $105 does not grow. That's a mistake that a person can make. So if you're wondering why it's not growing faster, it's because it's only off this $5 base, not a $105 base. After 10 years, you should have $170 given your $100 starting point, and that works out to this 5.45% CAGR. This is almost exactly where the rest of the S&P 500 on average is priced at. So it's, relatively speaking, it's valued the same basically as the market. The question I think a person needs to ask is, do you want to own a stock that's going to probably, if everything carries on, produce kind of average performance without much prospect of growth? Probably also without much of a prospect of like a deep killer decline. It's because earnings are pretty steady. Even if you take, I think they had some M&A during this period here, and that helped propel the stock downward. They may have announced something this year too. I'm not sure what this is all about, honestly. I didn't look it up. So it has fallen 50% in the past. Let's see what it did during the Great Recession. And the reason I'm just looking at this is because if you think, well, it's safe, it can't fall, it probably won't fall very much, at least if I can just get my safe, maybe 4% or whatever. Some people might be. So it fell 30%. So it fell less during the financial crisis. PE was a little bit more expensive. They also had they had quite a bit better growth during these few years here too, though. So overall, I mean, this is like market average performance, but you don't have, and it's not going to go bankrupt tomorrow or anything, but you don't have the prospect of a lot bigger growth or longer term growth probably. So that would be the sacrifice that a person's making. Also, cash yields 5.3% right now. So for the next year at least, you can get the same return, the guaranteed basically return prospects as you can over the compared to the long-term prospects of General Mills. So for me, like I just hold treasuries instead of buying a stock like this, and then I look for something with faster growth, with kind of bigger upside potential, or maybe something trading at a bigger discount. So if this was trading at half what it was doing and it had like a 7% dividend, I mean, now I'm getting interested, because maybe if they turn things around just a little bit, then you get more growth. And then so there's other ways you can win if you buy it cheap enough. Like, I don't know what it was here, 12 PE. Yeah, so that's like, so 15 down to 12. So that's like, we'll call it 35% lower valuation than where it is now. So they didn't change anything during this entire time. But if you bought it when it was super cheap and then you got the correction back to slightly overvalued, in that situation, you can get 70% return in a few years, right? Or a 45% CAGR. That's a setup where you could tempt me. And the reason they were probably able to do that is they had this like 12% growth year and the market got excited, and then that's how you could potentially get outsized returns, even though nothing really changed very much with the business. I don't know what the dividend yield, if it'll tell me the dividend yield at this point. Nah, I don't think I can see it. I'd have to probably calculate it. But $37.02. Yeah, I don't have my calculator here, but I'm sure the yield was probably higher as well. Maybe here you get a taste for it. Yeah. So that was probably a 5% yield at $42, another 10% lower. So yeah, or not quite a 5. So yeah, that was like a 5% yield. Closer to my 7. I mean, I'm a bargain hunter, so I mean, but at least you're kind of getting it cheap enough. And so I don't think it's cheap enough here to tempt me with a borderline growth type of situation. But if it was maybe about 35% cheaper, maybe you get me, and I have a bunch of cash, maybe it looks like a recession's ending or something, that might be enough to get me tempted to buy it. So I do track it. I think it's valued the same as the market, but I just don't find it attractive because I don't think the growth's there. All right, thanks for watching. If you have a request, put it down in the comments section. If you found this useful, hit the subscribe button, and I'll see everybody later.